On November 7, 2023, the S&P 500 and the Nasdaq finished higher to clinch the longest winning streaks since November 2021. It could be argued that it is about time. The S&P 500 closed at 4,378.38, which is 6.5% lower today than its closing price of 4,682.85 on November 7, 2023. Over the past 24 months, the capital markets have suffered one of the more adverse environments a market may endure, a Fed rate hiking process. We believe we are near the end of this process, which is typically associated with the end of one business cycle and the beginning of a new one. Perhaps we are not alone. Fidelity's fall investment themes illustrates the point in two pictures. This first picture illustrates the historical order of the bottoming process. The stock market drops first, then we have a recession as the actual economy falls second. A critical takeaway from the 6 instances illustrated is that the markets may rise even as the economy falls. This may be because the stock market is a forward-looking mechanism. This second picture from the same report illustrates the business cycle. We see a graphic depiction of where each of the world's major economies are in the business cycle. According to this, the end of a business cycle is often associated with a recession and the loosening of the Federal Reserve's monetary policy. The recent rise in the stock market may be the capital markets sniffing out a definite end to the Fed rate hiking process. From the November 3, 2023 issue of Larry Adams' Weekly Headings, we read,
"While Chairman Powell wants to keep open the possibility of another rate hike, below are 3 reasons we think the Fed is done with its tightening cycle. Number 1, economic growth will slow in the coming quarter. This week's ISM manufacturing survey reported that activity remained in contractionary territory for the 12th straight month. Consumer confidence fell for the 3rd straight month to its lowest level since April. Housing affordability is at the lowest level since the early 1980s, existing home sales have slowed to the weakest level since 2010, and loan demand is likely to fall for the 5th consecutive quarter in the next week's senior loan officer survey. Number 2, labor market strength is easing. The employment subsector within the ISM manufacturing report declined into contraction territory for the 3rd time in 4 months. Continuing claims have risen to a 6-month high, and the duration of those unemployed is climbing, suggesting that it is taking longer to find jobs. The percentage of consumers that viewed jobs as plentiful declined to the lowest level since March 2021. Number 3, disinflationary trend remains intact. Core inflationless shelter was up 1.9% year over year in September, down from a peak of 10.6% in June 2022. Powell remarked that wage growth is nearing a level that is consistent with the Fed's inflation objective. The Manheim Used Vehicle Index is down over 18% from its peak.
The end of a Fed tightening cycle is historically a positive catalyst. We may be at the end of the Fed's rate hikes. We may be on the cusp of passing through the end of one cycle and at the beginning of a new one. This may offer a more favorable environment for risk assets. Going back to weekly headings, we read the following.
While rising interest rates and aggressive monetary policy have been a headwind for the equity and bond market over recent months, when this trend ends, we may enjoy a much more favorable investment environment. In fact, in the 12 months following the final Fed rate hike, the equity market is up 14% on average, and is positive 75% of the time. These historical relationships embedded within our forecasts are one reason why we see upside for equities into year-end and over the next 12 months.
Since we are not able to predict the future with perfect accuracy, we strive to make efficient frontiers comprised of multiple asset classes. From this chart, we see that every asset has its own performance, and we believe being diversified allows one to take an effective middle path. Having a well-diversified portfolio may help avoid extreme portfolio declines. As of June 30, 2022, the worst performing asset class, U.S. small cap, was down over 23.4%. As we can see from the chart, a well-diversified portfolio was down only 15.5%. Often, the worst performing asset class in one year may perform best in a subsequent year. In 2020, the worst performing asset class was real estate, down over 11.2%. The following year, in 2021, it was the best, up over 45.9%. This next chart illustrates the consequences of the most extreme negative that may come from owning an investment. Here are a few key takeaways from the upside of downside protection. Number 1. The more your account declines, the more you must earn to recover your losses. For example, if a portfolio fluctuates down 10%, your account needs to appreciate 11% to get back your loss. However, number 2, the amount you need to make back when you have increased losses grows with the increase in the loss. If you are down 40%, you need to make back 67% to break even. We favor diversity of asset classes, so at any given time, we may have a competitive investment. Conversely, we may expect that there are elements in a diversified portfolio that are underperforming. This is why a portfolio may benefit from rebalancing. There are 2 other reasons to regularly rebalance a portfolio. Number 1, a rebalance may reduce exposure to asset classes that are challenged by specific macroeconomic events. Conversely, the same set of macroeconomic circumstances may prove advantageous to a specific asset class. Number 2, rebalancing may replace investments that underperform within an asset class with those that are outperforming in that asset class. If you look at this next chart, you will see that the markets started to fall in November 2021, 2 years ago, immediately after this article, titled, Jerome Powell Ditches Transitory Tag, Paves Way for Rate Hike. We must remember that the stock market tends to anticipate. It attempts to understand and act on what is ahead, so it fell 4 months prior to the first actual increase in interest rates in March of 2022. It may be the case that this month's increase in the stock market is in anticipation of the Fed pivoting from rate increases to rate decreases. We may not know this conclusively. However, what we may reasonably expect is that the Fed will pause, and perhaps pivot. Furthermore, if history is any guide, this may foster an investment environment that is much more favorable for risk assets. We may do best investing in these investments now, because they have recently declined in price. This may make them very compelling opportunities.